Picture this. It's a Tuesday morning. You're sitting at your kitchen table, coffee in hand, scrolling through your phone, and you see a news headline that says something like, "Stock market drops 800 points." Your stomach does a little flip. You put the phone face down, you pour more coffee, and somewhere in the back of your mind, a small, uncomfortable voice whispers, "Should I be doing something? Do I even have money in the stock market? What actually is the stock market?" If that's ever been you, a euro, and I'd bet a lot of money it has been most of us, a euro, then welcome. You're in exactly the right place. Today we are going to talk about finance and investing. Not the dry, textbook, here's a chart of compound interest from 1974 version. No, we're going to talk about it the way a brilliant older cousin would explain it to you over that same cup of coffee. We're going to make it real, we're going to make it practical, and by the time we're done, that uncomfortable voice in the back of your head is going to sound a lot more like a calm, informed friend. Let's start at the very beginning, not with stocks or bonds or mutual funds. Let's start with something even more fundamental, the relationship between you and your money. Section 1, a euro. Your money has a personality. Here's a way to think about money that nobody really teaches you in school. Your money is not just sitting in your wallet or your bank account being neutral. It is constantly doing one of two things. It is either working for you, or it is slowly being eaten alive by something called inflation. Inflation is basically the economy's way of saying everything costs a little more every year. On average, inflation runs at about 2 to 3% annually in most developed economies. That sounds small, right? Almost adorable. 2%. Barely a rounding error. But here's what 2 to 3% actually means in practice. If you stuff $10,000 under your mattress today, a euro, which please don't do, but hypothetically a euro in 25 years, that $10,000 will only have the buying power of roughly $5,500 in today's dollars. You didn't lose any money in the traditional sense. You still have your 10,000 bills, but the world got more expensive around you, and your money didn't keep up. Inflation is basically a slow, invisible tax on doing nothing with your savings. This is the first and most important reason why personal finance matters. Not because you want to be rich, necessarily, but because understanding where your money goes, a euro, and making sure some of it is growing, a euro, is the difference between financial stability and quietly falling behind. So what does working for you actually look like? It starts with something deceptively simple, budgeting. Section 2, a euro, budgeting, the unglamorous superpower. Nobody made a viral TikTok about budgeting. Nobody is posting their 503020 budget breakdown with a DJ drop and confetti. But budgeting is genuinely the foundation of everything else in personal finance, and ignoring it is a little like trying to build a house without pouring a foundation, because foundations are boring and you just want to get to the nice windows. Here's the most famous and most practical budgeting framework, the 503020 rule. The idea is simple. Of your after-tax income, a euro, the money that actually lands in your account, a euro, you allocate 50% to needs, 30% to wants, and 20% to savings and debt repayment. Needs are things like rent, groceries, utilities, transportation to work, non-negotiables, the stuff that keeps your life running. Wants are the restaurant meals, the streaming subscriptions, the new sneakers that were absolutely on sale and you needed them, and the 20%, that's the powerful part. That's the part that builds your future. Now, I know what some of you are thinking. 20%? I can barely cover my needs with what I make. And look, that's a real constraint for a lot of people, and we're not going to pretend it isn't. But here's the thing. The 503020 rule isn't a law. It's a compass. Even if you can only save 5% right now, the habit of saving anything consistently matters enormously. We'll see why in a moment. Before saving even becomes possible, though, there's one enemy you have to face head on, and his name is debt. Section 3, a Euro debt, the complicated villain. Not all debt is created equal. This is important, and it's something that a lot of people get confused about. Debt has two very different personalities, and knowing which one you're dealing with changes everything. The first is what we might call good debt, a Euro, though even calling it good feels a bit generous. This is debt with low interest rates that finances something that grows in value or builds your earning potential. A mortgage on a home, for example, or a student loan that leads to a significantly higher paying career. The idea here is that the thing you borrowed money for is worth more or earns more than what the debt is costing you over time. The second type is consumer debt, credit card debt, payday loans, high interest personal loans, and this stuff is genuinely vicious. The average credit card in the United States charges an interest rate of somewhere between 20 and 29% annually. Let that sink in for a second. If you carry a $5,000 balance on a credit card at 25% interest and only make minimum payments, it will take you over 20 years to pay it off, and you'll end up paying around $8,000 in interest alone. You'll have paid more than twice the original amount, a Euro, for the privilege of borrowing. The practical takeaway here is devastatingly simple. If you have high interest debt, paying it off is almost always the best investment you can make. There is no stock, no index fund, no crypto coin that reliably returns 20% per year. So paying off a 20% interest card is, mathematically, as good as a guaranteed 20% return on investment. Once the high interest debt is handled, a Euro, or at least under control, a Euro, you build your emergency fund. Section 4, a Euro, the emergency fund, your financial immune system. Your emergency fund is not exciting. It is not going to make you rich. It is not going to beat the S&P 500. What it is going to do is prevent one bad month, a Euro, a broken car, a medical bill, a sudden job loss, a Euro, from completely derailing your financial life. The general recommendation is to have 3 to 6 months of living expenses saved in a liquid account. Liquid just means you can access it quickly without penalty, a Euro. A high-yield savings account works perfectly for this. Not invested in stocks, not locked in a CD, just sitting there, quietly and boringly, ready to be deployed if life throws something at you. Think of the emergency fund as your financial immune system. When you have it, a $1,500 car repair is annoying. When you don't, it becomes a credit card charge that follows you around for 2 years accruing interest. Okay, so you've got a budget, you're tackling debt, you've got your emergency fund growing. Now we get to the part everyone actually came here for, investing. Section 5, a Euro, the magic of compound interest. Albert Einstein may or may not have called compound interest the eighth wonder of the world, a Euro. Historians are divided on whether he actually said it, a Euro. But whoever said it was right, and they deserve a trophy. Here is the core concept. When you invest money and it earns a return, those earnings then also earn returns. Your gains generate their own gains. And over time, this creates a snowball effect that starts small and gets almost comically large. Let's make this concrete with real numbers, because this is where it gets genuinely mind-blowing. Imagine two people, Maya and Jordan. Maya starts investing $200 a month at age 25 and stops at age 35, a Euro, just 10 years. She invests $24,000 total and then never touches it again. Jordan waits until age 35 to start and invests $200 a month, all the way until age 65, a Euro, 30 years. Jordan invests $72,000 total, assuming an average annual return of 8%, a Euro, which is a historically reasonable long-term average for a diversified stock market portfolio. A Euro, Maya ends up with about $375,000 at age 65. Jordan ends up with about $298,000. Maya invested for only a decade and contributed a third as much money, and she still ends up ahead. Why? Because she started earlier, and compound interest had more time to work. Time is the single most powerful ingredient in investing, not skill, not stock picking ability, not following the right influencer on social media. Time, which means the single best time to start investing is right now, even if it's a small amount. Section 6, a euro, the stock market. What it actually is. Okay, let's demystify the stock market, because the way it gets talked about in the news makes it sound like some kind of incomprehensible, volatile beast that only professionals can understand. A stock is, at its core, a tiny piece of ownership in a company. When you buy a share of Apple or Toyota or a Nigerian cement company, you are literally a part owner of that business. If the business does well, your share becomes worth more. If it does poorly, it's worth less. Simple as that. The stock market is just the marketplace where people buy and sell these ownership stakes. It goes up when people are generally optimistic about companies and the economy, and it goes down when they're not. In the short term, it can be wildly irrational, a euro, driven by fear, rumors, and the mood of the day. In the long term, it has historically trended upward because the global economy has historically grown. Here's an important stat. The US S&P 500 a euro, an index of the 500 largest American companies a euro, has averaged roughly 10% annual returns over the last century. Not every year. Some years it dropped 30 or 40%, but averaged out over time roughly 10%. That's why long-term investors who stay in the market through downturns have historically done very well. And this brings us to one of the most important investing concepts you'll ever learn: diversification. Section 7, a euro, diversification and index funds. Don't put all your eggs in one basket, or your nest egg, for that matter. Here's an analogy. Imagine you're at a farmer's market, and you can either spend your entire budget on one vendor's tomatoes, or you can buy a little of everything: a euro tomatoes, peppers, mangoes, plantains, ground nuts, the works. If the tomato guy has a bad season, you're fine because the mango lady is thriving. That is diversification. In investing terms, it means spreading your money across many different assets so that if one goes down, the others can buffer the impact. And the easiest, most cost-effective way to diversify is through index funds, or ETFs, a euro exchange-traded funds. An index fund doesn't try to pick winners. It just buys a little bit of everything in a given market index. An S&P 500 index fund, for example, automatically owns tiny slivers of all 500 of the biggest U.S. companies. When the market grows, you grow with it. And because no one is actively trying to beat the market a euro, just match it a euro, the fees are extremely low. This is actually a revolutionary insight that took decades for the finance industry to accept. The majority of professional fund managers, with all their research and expertise and expensive suits, do not consistently outperform a simple index fund over the long term. The data on this is remarkably consistent. According to the S&P SPIVA report, over a 20-year period, around 90% of actively managed U.S. equity funds underperform their benchmark index. 90%. For most investors, boring and diversified absolutely crushes exciting and active. Section 8, a euro. Bonds, real estate, and asset allocation. Stocks aren't the only game in town. A well-rounded investment portfolio typically includes bonds as well. A bond is essentially a loan you give to a government or corporation. They promise to pay you back with interest over a set period. Bonds are generally less volatile than stocks a euro. They don't swing up and down as dramatically a euro, but they also tend to offer lower long-term returns. They're the calm, reliable part of a portfolio that balances out the more energetic stock portion. The classic rule of thumb used to be to hold your age in bonds. So if you're 30, hold 30% bonds. If you're 60, hold 60% bonds. The idea being that as you get older and closer to needing your money, you want less volatility. Many modern financial advisors now suggest even younger investors can hold more bonds for stability, but the underlying principle is sound. Balance risk with your timeline and your stomach for uncertainty. Real estate is another major asset class that deserves mention. Owning property has historically been one of the most reliable wealth-building tools globally. It provides rental income, potential appreciation in value, and some protection against inflation since property values and rents tend to rise over time. The challenge is that it requires significant capital up front and is far less liquid than a stock portfolio. If you need cash tomorrow, you can't sell your apartment building by Thursday. But for long-term wealth building, real estate remains powerful a euro. And for many people around the world, including across Africa, land and property ownership is among the most culturally and financially significant assets one can hold. Section 9, a euro. Retirement accounts, the government's secret gift to investors. Here's something governments don't advertise loudly enough. They will actually help you pay less in taxes if you invest for retirement through specific account types. In the United States, these are called 401ks and IRAs. In the UK, they're called ISAs and pensions. Many African countries have pension schemes like Nigeria's Contributory Pension Scheme, Kenya's NSSF, or South Africa's retirement annuities. The structure varies, but the principle is broadly similar. These accounts offer what are called tax advantages. Either you invest pre-tax money and pay taxes later when you withdraw, traditional, tax-deferred, or you invest money you've already paid taxes on and never pay taxes on the growth, Roth, tax-free. Over decades, these tax savings compound just like your investment returns do, and they can add up to tens of thousands of dollars, a euro, or the equivalent a euro over a lifetime. If your employer offers a contribution match on a retirement account, a euro, meaning they'll match whatever you put in up to a certain percentage a euro, take it, always. An employer match is literally free money, and turning it down is the financial equivalent of leaving a winning lottery ticket on the sidewalk. Section 10, a euro, common mistakes in behavioral finance. We'd be doing you a disservice if we didn't talk about the human brain for a moment, because it turns out our brains are not naturally wired for good investing. We are emotional, social, loss-averse creatures, and the stock market is very good at exploiting exactly these tendencies. The most common and most costly mistake investors make is panic selling a euro, dumping their investments when the market drops because it feels terrible to. Watch your account value fall. Here's the brutal truth about that. By selling during a crash, you lock in your losses permanently. The market has recovered from every single crash in history. Every one. The investors who stayed in, or better yet, kept contributing during downturns, recovered and then some. The ones who sold in panic locked in losses and often missed the recovery entirely. Related to this is something called recency bias, a euro. Our tendency to assume that whatever has been happening recently will continue to happen. When the market has been rising for years, people feel confident and pour in money near the top. When it's been falling, people bail near the bottom. This is essentially the opposite of the buy low, sell high principle that every investor knows intellectually and almost nobody follows emotionally. The antidote? Automation and consistency. A strategy called dollar cost averaging means investing a fixed amount at regular intervals, a euro, say, every month a euro, regardless of what the market is doing. Some months you buy when it's expensive, some months you buy when it's on sale. Over time, it averages out, and you're protected from the temptation to try timing the market, which is extraordinarily difficult to do successfully and consistently. Section 11, a euro, a word about crypto and hot investments. We can't have this conversation in 2025 without at least acknowledging cryptocurrency and other highly speculative investments that dominate financial, social media, Bitcoin, Ethereum, meme stocks, NFTs, whatever the next shiny thing is by the time you're watching this. Here's an honest take. Cryptocurrencies are real. Blockchain technology is real. And yes, some people have made extraordinary amounts of money. But for every person who turned $1,000 in Bitcoin into a fortune, there are many more who bought near the peak and watched their investment drop 70, 80, 90%. These assets are highly speculative, not backed by earnings or physical assets, and deeply sensitive to sentiment and manipulation. The practical advice: if you want to participate in crypto or other high-risk assets, keep it to a small portion of your overall portfolio, €1. Many financial advisors suggest no more than 5 to 10% of your invested assets in highly speculative positions. Treat it as money you're willing to lose entirely. Never invest money you need, money that's earmarked for emergencies, or money you've borrowed. The boring truth is still the truth. Diversified, low-cost index funds held over long periods of time have consistently produced wealth for ordinary investors. It's not exciting. It won't make a great story at dinner. But it works. So let's bring it all home. Finance is not a subject reserved for math geniuses, Wall Street traders, or people who read the Financial Times on leather-bound armchairs. Finance is about understanding the relationship between your money and your time, and making small, consistent decisions that accumulate into something meaningful. Start with a budget, €1, even a rough one. Kill the high-interest debt aggressively. Build an emergency fund, because life will throw a curveball eventually. Then invest consistently in diversified assets as early as you possibly can. Let compound interest do the heavy lifting. Don't panic when markets fall. Automate what you can. Use tax-advantaged accounts where they're available. And be deeply skeptical of anything promising extraordinary returns, €1. Because if it sounds too good to be true, it has been too good to be true since the first con artists walked this earth. And perhaps most importantly, think in decades, not days. The financial news cycle wants you anxious, because anxious people click things. The market's daily movements are noise. The long-term trend of a growing global economy is signal. That Tuesday morning headline that made your stomach flip? Here's the real story behind it. It doesn't matter if you have a solid plan, you're invested for the long term, and you don't panic. The market will drop. It always has. It will also recover. It always has. Now you know enough to start, and starting is the entire game.